I mean, investing. It could be the best financial move you make. And while you might earn a steady paycheck from working, investing can put your hard earned money to work for you. A wise, crafted investment portfolio can really help you build tremendous wealth over time, right? That you can use for your retirement, send your kids to college, or for whatever financial goals you might have. And it's fairly common knowledge that investing is a good move. There's also a question of what you invest in, which is an extremely important part of the puzzle. With that in mind, we're going to take a closer look at some of the popular investment vehicles, pluses, minuses, kind of examine how they fit into maybe your ideal strategy. Well, we're going to start off with why stocks are a good investment for pretty much everybody. I mean, almost everyone should own stocks, right? Because stocks have consistently proven to be the best way for the average person to build wealth over the long term. US stocks have delivered better returns than bonds, than savings accounts, precious metals, most other investment types over the past 40, 50 years. Stocks have outperformed most investment classes over almost every 10-year period in the past century and have averaged annual returns of about 9 to 10% over long periods of time. So, to put returns like this into perspective, a $10,000 investment compounded at 10% for 30 years, it's about 170, $180,000. That's just putting $10,000 in an account and leaving it there. That's it. Now, why have US stocks been so good? Well, because as a stockholder, you're owning part of that business. And as that business gets bigger and more profitable, and as the economy grows, you own a business that becomes more valuable, right? As the great Warren Buffett would say, investing in US stocks is a bet on American business. And this has been an excellent bet for more than 2 centuries. Now, we can use the past 20 years as an example. Even across three of the most brutal stock market declines in history, the stock market has delivered better returns than gold or bonds. So think of the S&P 500 index, right? Considered to be the best barometer of how large US stocks are performing. Over the past 2 decades, delivered a 540% total return, which includes stock price gains as well as dividends. In other words, a $10,000 investment could have turned into a $65,000 investment, and that's including the effects of the 2008 financial crisis, the COVID 2020 crash, and the bear market that happened in 2022. Now, of course, there's downsides of investing in stocks. They're not risk free. Even the most stable companies' stocks can fluctuate dramatically over short periods of time. We look back at the past 50 years, S&P 500 has, declined by as much as 37% in a single year, and it's risen by as much as 38%. Now, because of their tremendous wealth building potential, stocks should make up the foundation for most people's portfolios. What varies from one person to the next is how much stock makes sense. For example, someone in their 30s, saving for retirement, can ride out many decades of market volatility and should own almost entirely stocks. But someone in their 70s should own some stocks for growth. The average 70 something American will live to be in their 80s, but they should protect assets they'll need in the future by investing into bonds and holding cash, right? Now, there's two main risks with stocks: volatility, right? Which is just the stock price is just swinging broadly every which way, and then permanent losses. Right? Stockholders are business owners, and sometimes businesses fail. The risk can be mitigated by focusing on established and stable businesses and creating a diversified portfolio of stocks, choosing to invest in ETFs or mutual funds. Right? And you got to manage that volatility, right? If you've got kids heading off to college in a year or two, or if you're retiring in a few years, your goal should no longer be maximizing growth. It should be protecting your capital instead. So it's time to shift the money you'll need in the next several years out of stocks into bonds and cash. Now, if your goals are still years in the future, you can hedge against volatility by doing nothing. Even through some of the worst market crashes in history, stocks have delivered some pretty crazy returns for investors who just held out. Now, we need to avoid permanent losses. We don't want to lose money, right? We want to make money. So the best way to avoid permanent losses is to own a diversified portfolio without too much of your wealth concentrated in any one company, industry, or market. Diversification will help limit your losses to a few bad stock picks, while your best winners will more than make up for their losses. Let's think about it this way. If you invest the same amount in 20 stocks and one goes bankrupt, the most you can lose is 5% of your capital. Now, let's say one of those stocks goes up 2,000% in value. It makes up for not just that one loser, but would double the value of your entire portfolio. Diversification can protect you against these permanent losses that we just don't want. Another effective way to avoid permanent losses is you want to invest, either exclusively or partially, kind of up to you, in ETFs or mutual funds. So if you invest in an S&P 500 index fund, your money is going to be spread out among the 500 companies that make up that index. And therefore, it wouldn't be devastating if any one of them were to fail. But then you got to ask yourself, how much money are you going to put into stocks? Everyone's different. There's no rule of thumb for that. But one popular asset allocation guideline is to subtract your age from 110 to determine the approximate percentage of your portfolio that should be in stocks. So if you're 40, right, 110 minus 40, then 70. 70% of your money in stocks. So what about bonds? It's something else we can invest in. Why would you invest in them? Well, in the previous example, you might be wondering where the other 30% of that 70% money should go. And generally, it's going to be in something stable, income producing, bonds, right? Or fixed income securities. Now, over the long term, growing wealth is the most important step. But once you've built that wealth and get closer to your financial goal, bonds, which are loans to a company or government, they're going to help you keep it. But there's three main types. We have corporate bonds, right, issued by companies, municipal bonds, issued by state and local governments, and then treasury notes, bonds, and bills issued by the U.S. government. So using the Vanguard Total Bond Market ETF, which owns short and long-term bonds, and the iShares 1 to 3 year Treasury ETF, which owns most of the Treasury bonds, compared to the S&P 500, you can see, if you go look at these, how crazy the difference is with how the bonds just stay stable paying out, and they make up for losses you have from stocks going down, and the bonds just keep paying and paying, and you're good. And as you get closer to your financial goals, owning bonds that match up with your timeline, going to protect your assets, and you'll be counting on those in the short term. Now, of course, we can't forget about everyone's favorite, real estate. But you don't need to own physical real estate. You can invest in real estate in the stock market. Just like owning great companies, owning real estate, wonderful way to build wealth. In most recessionary periods throughout history, commercial real estate has been counter-cyclical to recessions. It's often viewed as a safer, more stable investment than stocks. But there are ways for people at almost every financial level to invest in and make money from real estate. Right? Rental properties, which can be a great way to build wealth and income, but it isn't the best fit for everyone. Fortunately, there are alternative ways, right? REITs, publicly traded REITs or real estate investment trusts, are the most accessible way to invest in real estate. REITs trade on stock market exchanges just like other public companies. We've got American Tower, owns and manages communication sites like cell phone towers. Public Storage owns about 3,000 self-storage properties in the U.S. and Europe. Avalon Bay Communities, right, largest apartment and multifamily residential property owners in the U.S. I mean, REITs are excellent investments for income since they don't pay corporate taxes, as long as they pay out about 90% of the net income in dividends. Now, it's also easier to invest in commercial real estate development projects, more so now than ever. In recent years, legislation made it legal for real estate developers to crowdfund capital for real estate projects. As a result, billions of dollars of capital has been raised from individual investors looking to participate in real estate development. Now, it takes more capital to invest in crowdfunded real estate, but if that's what you want to do. And unlike public REITs, where you can easily buy or sell shares, once you make your investment, you may not be able to touch your capital until the project is completed. Now, there's also a risk that the developer doesn't execute, and you just lose all your money. But the potential returns and income from real estate are compelling, and have been inaccessible to most people until recently. Crowdfunding is changing that. So at the end of the day, there's a bunch of different ways for you to invest. There's a bunch of different, just you have so many options, which is why we always tell people you need to do the research, figure out what's best for you. Because again, what's best for me is not best for you. That's not best for your parents. What's best for you, do your research, make a plan, and just do it. Just stick to the plan, right? That's going to be the hardest part, sticking to the plan. And the other thing you need to stick to is making sure that when you make your plan, the plan makes sense. Don't make something unreasonable. Like you want to invest to where your portfolio makes you millions of dollars a year. Like, come on. You could make a portfolio that gets to be over $1 million, but paying you that's a lot of money. So, again, at the end of the day, do your research, do what's best for you, right? If you also want to do something great, you can subscribe to the channel. You like this video, right? And then when you do that, that means I'll see you in the next one. But until then, y'all be safe.